Today I will present kind of a more academic work, even if it's outside academia. It's more kind of theoretical work we have done as a result of people challenging us. Since you have all this data on the oil market, why can't you try to make a dynamic simulation of the oil price, what is really going to happen going forward? Basically we have done that, and I will share with you some of the results and the methodologies today. But just to set you in the right kind of thinking, I will start with a slide that is 90 years old. It is this one. And what you see here is from an article written by the German scientist Arthur Hanau in 1927. And what he did was to collect all the pork prices on the market in Berlin between 1896 and 1914. And that was the first time they really, in a scientific way, was gathering all this market data. And what he observed was that every year around Christmas, the pork prices were very high. But moreover, the pork prices were typically high for 2 years, and then very low for 2 years, and then very high for 2 years, and then additional very low, again very low for 2 years, etc. And the pattern was just repeating itself. And then he went in to make interviews with the farmers. What did they do? And he found out that when the pork prices were high, a lot of new farmers were establishing pork farms because it seems to be a very, very profitable business. And they did so. But it takes about 2 years to build up a full production system. So basically, when all the new pork farm came in to the market after 2 years, it was oversupply and price collapse. And then we can imagine the discussions within the farm that well, this was not a profitable business in any case, so let's just shut down. We didn't earn money. And a lot of the farmers shut down their business, and after 2 years it was undersupply and the prices fly up again. And this pattern was repeating itself, and it was basically very little learning in this market because it was little transparency. People took decisions on the current price of this commodity, and they didn't really forecast what was going to happen in the future. And this was one of the first descriptions of a typical commodity cycle. This is the so-called hog cycles or pork cycles. But you find the same cycles in almost all the commodity markets, like even in the crude tanker market, or in a lot of these markets where that is need, especially when you need big capital investments, and there's a lag between the decision and the effect of that decision. So let's look at how this is in the oil market. Is it as simple as it is in the pork market? No, not really, because in the oil market you have several cycles, because one cycle is to establish new infrastructure for oil production, meaning that you have the processing facilities, the evacuation system, which is pipelines or railways or whatever, and basically the facility to drill additional wells. And this is what we call the long cycle, because it takes time. It takes typically 5 to 7 years from the decision, and this is from the oil price signal. If it's high, you want to invest a lot in the new facilities, and then after 5 to 7 years you get the production, and then finally this will influence the oil price. So this is primarily today and over the last decades has been offshore platforms. 89% of the investments has been in offshore. and 80% is facilities, while only 20% is directly related to the wells. And typically this is 3 million barrels, or 1 to 2.5 million barrels, I mean, that you get out of this. But on the peak years, you can get up to 3 million barrels from this cycle. The other cycle is onshore wells, where you already have existing facilities, or additional infill wells on, for example, shelf platforms. And this is what we call the short cycle. And here is only 1 to 2 years from the decision, from the oil price signal to the investment decision and to the production effect, that it will again influence the market. And this is primarily well investments. 60%, 70% of the investments are well. And this is primarily onshore, but also some facilities, so some additional infill wells on shelf. Also influencing the oil price is what we can call the shock cycle, which is other events like demand shocks, either up or down. For example, the financial crisis was typically an external event introducing a demand shock. Or it could also be supply disruption, sudden events, whether it's wildfire in Canada or whether it's a war in the Middle East or other shocks coming to the market. So this is the theory. We have tried to then implement this theory into a mathematical model. So basically based on all the data we have field by field in UCube, singling out what is the approval date for a project, either a project to develop a new facility, like a long cycle project, or a project to develop additional infill wells on existing fields. So this is just illustrating the timeline from current oil price into the future. So this could be quarters into the future, or half years into the future, basically indicating that this long cycle is going to influence the production far into the future, while the short cycle is influencing the production shorter time into the future. And also in the model, we are using a dynamic demand picture based on the oil price. Basically, if the oil price is high, the global GDP will be slightly lower because oil is taking a bigger part of the global spending, and the demand is slightly adjusted down, and then which again will influence the oil price. Of course, you also have structural factors that will influence the demand, like electrical vehicles and this kind of disruptions that will come into the future. But this is not the topic for today's conversation. So in the model, we are implementing all of this, and we also make it possible to put in OPEC cuts in the model, all kind of supply disruptions, or other effects related to fare or relief of fare. And we're doing separate analysis for offshore deepwater, midwater shelf, for oil sands, for other onshore, and for the shale and tight oil. And for the shale and tight oil, the short cycle is only 7 months. From the price signal until you make the decision to drill, and until you have completed it, the average time is only 7 months. And this is introducing something really new to this dynamic system. So for the shale, we are doing month-by-month analysis in this model. For other onshore, we are doing quarter-by-quarter. And for the long cycle, we are looking at annual decisions based on the average oil price the last year. So just to repeat, if you have the current production every year, the well level decline is about 8 million barrels. It's typically a decline of 8 to 10%. It's higher decline after an oil peak, because then you have more new wells, and new wells are declining faster. And when you are in an oil floor, then you have slower decline, but it oscillates between 8. And then the short cycle is giving you additional 6.5 million barrels of new oil, and the long cycle could give you up to 3 million barrels of new oil, meaning that you have additional demand growth that you can compensate for that with about 1.5 million barrels, which is a typical demand growth. So just to see, how can we model this? Then we need some functional relationship between the supply and demand, which is the implicit stock build, and the oil price. And we have been investigating this quite much and found the formula for this relationship. And I will show you some of the results. So this orange curve is the oil price. However, on a logarithmic scale. So you see it's 14 and it's doubling to 28, doubling to 56 and doubling to 112. And this is very important because the relationship is much stronger if you look at the logarithmic development of the oil price than if you look at the linear actual. So actually what you should look at is the percentage change of the oil price. The other relationship is this gray line, which is accumulated stock draw. But this means actually implicit difference between demand and supply. And just to explain this for you, from 1997 January until October 1998, you see it's a stock build of approximately 1,000 million barrels. And this is for like 500-600 days. Meaning that you have 1.7 million barrels per day in imbalance. So with this difference, the oil price actually halved in this period. And you see, when the stock draw started, the oil price started to go up again. And from 2000 to 2001, we see just the same pattern. And we see the same pattern in 2009, and partly in part of 2009 and 10 and 11 and 12 and 13, and very clearly in 14 and 15. And the functional relationship is actually that if you have a stock draw of 1 million barrel per day in a half year, oil price changes 30%. So if the oil price is 50 and you have a stock draw of 1 million barrel per day in a half year, 30% of 50 is 15, then the oil price will be 65 in the end of the year. And that is pretty much what we have seen this fall, for example. And it is a very clear historical correlation. However, if you are very observant, it's one period, it's not a clear correlation. And that is from 2003 to 2007. And what did happen? Well, this was the super cycle where all the demand increased a lot in Asia, in East Asia, in China especially. And what was the consequence of that? Well, we had to move a much more oil from the Atlantic Basin and from the Middle East to East Asia. And the tanker utilization, this is the chart for demand for trading for crude tankers, which is actually the total deadweight tons of crude tankers. And we saw that this grew from 240 to 315, which corresponds to actually that the oil in the tankers grew from 930 million barrels to 1,235 million barrels. So what happened was that the total supply chain expanded unproportionally much. So this is like working capital in a company, to give you an analogy. So basically the supply chain, when it expands more than the proportional growth of the total oil consumption, this is a demand effect in itself. And on top of that, it was strategic petroleum reserve building in China. So basically what we are including is also the supply chain size in the model. And when we do that, we get this gray line, which is an accumulated stock draw effect needed to compensate for supply chain expansion. And when this was actually growing with more than 1 billion barrels from 2003 to 2007, and with this effect, on top of this other gray line, we get a perfect, very strong correlation between the oil price and the fundamentals in the oil market. So this gives us actually the foundation for actually building a strong model on functional relationship between the fundamentals between supply and demand and actually the oil price going forward. And I've already given you the formula that 1 million barrel imbalance for half a year will give you 30% change up or down. So one other relationship we need to look at is then, is it like the hog farmers, that basically you do the investments very proportional with the current oil price, or are people thinking more strategically? Well, just to look at, for example, this is the number of new horizontal shale wells. And it was actually a structural growth from 2010 to 2013, since they had to learn how to do this, and it was a switch from vertical wells to horizontal wells. But after that, it's been almost a perfect linear relationship between the drilling of new wells and the actual oil price. And if you do this, this is the Brent oil price, but if you do it for the VTI, it's even stronger relationship. But it was also some kind of gains over the last years in terms of drilling for more thicker plays with higher injections. So we actually had much more productive wells also that came in. But still it's a very strong functional relationship. And it is the same actually even for infill wells. If you look at the number of wells in Brazil, in UK, other places, we see that very much it follows the current oil price. And also when you look at field development decisions, it's very correlated with the average last year's decisions. So basically oil managers, they are taking decisions based on the current oil price and the average oil price over the last year. So it's very meaningful to also make a relationship between this. So with this background, we are then making a model where we are looking month by month for what is the oil price as an input month by month. And with this oil price, we take decisions both for infill wells and for new field developments. And each month will then give you a new kind of time series of production that is already settled based on this month. And this will give you a new balance for the future. So then of course the mathematical system will have to be an iterative system where you are basically going in loops to dig you down further into the future. And so you have to run very many iterations of the model to make it stabilize. Typically it's 100 iterations is sufficient. So then we can see what is the result of this simulation. And I will show you some of these results now. And I will show one result for what we call the unrestricted simulation. And then this is actually a simulation from 2 weeks ago, just before the OPEC meeting, because we used this to look at what is the consequences of OPEC not prolonging their cuts or prolonging. And this is if they did not prolong their cuts, but we're opening up to bring all the OPEC oil back to the market in the spring of 2018. So this is basically OPEC only taking rational decisions for if this well is in the money, meaning it is economic to develop, they will develop it. Of course, if it's not economical to develop based on the current month's oil price, they will not do it. And since they're holding back production, this will, and when we have the unrestricted scenario, they will actually bring all this back. Of course, then we will see a boom of new oil coming into the market in 2018. Then we also have one other scenario, which is what we call restricted shale growth. Because many people think that shale cannot go on growing as fast as today. The investors will say stop, they don't get sufficient return, etc., etc. We don't need to know exactly what is the reasons for shale not to grow faster, but we can just make a scenario where we put that restriction into the scenario. So this is scenario 2. And finally, 3 This is a OPEC cut scenario where we are introducing an algorithm for OPEC, which is if the oil price goes below 60, we will cut 1.5 million barrels for 1 year, regardless of anything, you know. So this is a very kind of rigid algorithm from OPEC. I don't think they will have the discipline to do that, but let's just look at the scenario, what will happen if they were able to do that. Okay, so then we can look at results from this simulation model. And this is the first result from the unrestricted scenario, meaning that all oil is brought back in the spring of 2018. So what you see, this red line, this is the global oil supply. And this is 80 million barrels, 90 million barrels, 100 million barrels. So this is on the right-hand axis. And the gray is the global demand. All this is month by month. So what we see is that it was a huge oversupply in 2014 and 15. But this was brought into balance. And you see here in 2018, in the middle of 2018, we make this jump up, which is just this decision that OPEC is bringing their oil back. But all this resulting red line, that is a superposition of all these investment decisions, month by month, for shale, for deepwater, for onshore, infill wells, etc. All of this that is made into one big model. So this is really difficult to really understand or to intellectually have the perception to see the result of this, because it's so many different, you know, with so many months and so many effects. But of course, in a mathematical model in a computer, you can make these simulations. So, and then we see the result of this is that we get oversupply in end of 2018 and 19, but with the oversupply, we get the oil price collapse in 2018. This is today. And we get the oil price increase until the mid-2018, up to $80 oil. This is $80 oil. But then we get a continuous oversupply and a continuous oil price collapse until mid-2019. But what happens here is that all the short cycle oil will stop up at the oil price below 40. So shale will be very restricted, and also infill drilling. And this happens at the same time as the long cycle is already very weak. Because we started, as you see from the investments here, we started very few new projects to develop in 2014, 15, and 16, and 17. It's been very weak, long cycle decisions. But still, we have got a lot of long cycle oil coming into the market over the last 3 years, because we took so many decisions in 2011, 12, and 13 to develop new fields. So still we are kind of flooded by all decisions. So we must see this lag of 4 to 6 years. So basically, at the same time when we are arriving to 2021, 2022, we get a weak long cycle and we get a weak short cycle due to the oil price collapse in 2019. So then we get a huge undersupply globally in 2021, 22, and 23. And the oil price will fly up to very high levels, $140. And this will last for 2 to 3 years. As a result of that, we will start a lot of new long cycle projects, and we will have basically full speed of all the short cycle oil, all the infill wells, because at $140, people will go crazy again. They will just invest as much as they can. And it will take time to get all this new oil into the market. So only in 2025, we get a new super oversupply with a complete price collapse as a result. And this is actually quite similar to the super oversupply we got on the end of the last cycle. You see, the pattern is actually repeating itself. And then we get a quite balanced market, but at a very low oil prices for another 4 to 5 years. And then if you had a longer time series, you would see we actually got a new big cycle up. So with a totally unrestricted market, with no strategic decisions from OPEC, we get a 7-year cycle with 3 3 years very high oil prices and 4 years quite low oil prices, and that is actually going to last throughout the 1930s. So this is the dynamics if you just let the model run by itself. And then we can introduce different other, as I said, restrictions to this. And the first restriction is related to the shale, because here shale is growing at its peak. Shale is growing more than 1.5 million barrels. It's growing up to 2 million barrels a year in the most extreme years. And this is despite they have a decline of more than 1 million, 1.5 million actually. So shale is alone contributing with more than 3 million barrels of new oil in the peak years of growth. And this is more than half, or approximately half, of the short cycle. So actually shale has come into the global market and is taking half of the short cycle growth, as much as all the rest of the world together. So of course this has completely changed the dynamics in the oil market also since before 2010. And it's unavoidable. And also the world is totally dependent on shale. Even if you make a scenario with a flat shale production, the world will run into an energy crisis. We will not be able to have enough energy. So we need the shale to grow going forward. And just now we have introduced the restriction of the growth to 700,000 barrels per day, which still is very significant. It's half of the global growth. So, but with this scenario, as a response to the OPEC, again, OPEC will come in with all its volumes in the middle of 2018, but shale will not grow as much in 2019 that it would have been in the unrestricted scenario. So we get a slower oil price decline, and oil price will only decline from 80 down to 60 in 2019 and 2020. But since then you have a stronger oil price here, you have a stronger short cycle of most of the other parts globally. And then you will have, when the long cycle is then very weak in the early 2020s, then you will actually start the oil price to grow. But since the short cycle is already quite strong, you will not get a very steep oil price increase that we had here. You will get a slower oil price increase, and you will only reach $100. So, and then also it will be less super intensive investment. So your oversupply will be not so big as it was. So the next short cycle, next down cycle will be only 2 years rather than the 5 years we had in this case. And then we will get a new undersupply actually in the end of the around 2026, 2027, due to also a weak short cycle from given this downturn. And then I can show you the third scenario with this OPEC algorithm to cut 1.5 million barrels. And then you see here on the supply pattern that every time the oil price goes to 60, they cut. So we see up and down here the cut decisions. And then the oil price will actually oscillate between $60 and $80, which is what we think now is also the marginal cost of the suppliers that deliver the marginal oil globally. Meaning that, and which is actually still oil prices oscillating around approximately $70 in these cases. So then the oil price will not be allowed to get a downturn, but then you will never turn off the short cycle sufficiently to get a real upturn either. And in this decision, when we look at this is the scenario where OPEC actually will produce, where shale will produce the most of the oil, will get access to largest market share of the global market. So the one that will benefit the most from OPEC cutting is actually shale. Then I told you that the functional relationship was 30% change of the oil price for 1 million barrel imbalance for 6 months. But the historical relationship has actually been varying from 3% to 6%. So in the model, we can just look at the robustness of the model for different scenarios. So then here we are showing you this. If you have a very fast, very responsive oil price, you will get a somewhat different pattern. You will get a kind of a double dip or double peak in the oil market. While if you have a very slow reaction, like 3%, you get a slower and longer cycle. So this is the effect of actually playing with some of the parameters in this model. And when we are sharing this model also with the clients, we are opening up that they can, of course, play around with all these parameters to make their own kind of view on how the dynamics will be going forward. So it's not restricted to any fixed 5% relationship between the oil price. So, but the patterns are still quite similar. You will get a peak and you will get a downturn afterwards. So just to tell you also, what will the oil price be in 2025? And I think you all see that it could as well be $20 or at least $30 as it could be $130. We have no clue about that. It's a completely open question. But what we know is that if it has been high for 3 years, it's very likely that it will be low for 3 years. It's actually quite symmetrical. So you have to see what will happen going forward, and all kind of external event could influence this market. You could have supply shocks or demand shocks that will fundamentally influence this. Another point, first of all, also as you see the demand, if you look at just the gray line, and if you observe that carefully, you will see that it's, for example, here is flattening out. Because demand is also a function of the oil price. So just look at the gray line, you see how it varies also with the oil price. So demand is also a function of the oil price. But another thing is that you see that actually the demand curve is flattening out because we also have a peak oil demand in the model. And in this simulation that I just showed you, it's 2035. So we expect that the structural changes of oil demand due to electricity in the transportation sector and some other drivers is going to make the oil peak just 5 years later. But then we can also look at what is the consequences of an earlier peak oil. And here we are experimenting with 3 different peak oil demand scenarios, 2025, 2030 and 2035. So you see here is a bit complex to see the 3 different scenarios. Here is 3 different colors on the demand curve, but this is for 2025, so this is already on decline, and this is 2030 and this is 2035. Well, the results of the simulation is then showing that still we get these cycles up and down, but we get longer down periods if you have an earlier peak demand. So if you have a peak demand already 2025, we will see rather 2 to 3 years up cycle and 4 or 5 to 6 years down cycle on the worst. So it has, of course, a negative impact on the oil market if you get an earlier peak oil demand, but still you will get price fly-ups because the demand decline, maybe it could be up to 1 million barrels per day in 2030s and 2040s, but still underlying well-level decline is 8 million barrels. So we cannot shut down the oil industry. Still you have to invest a lot, even in a declining overall scenario. Also, we can look then in the model, you can use this to look at the different contributions to production in the different scenarios. So this is for example, the shale oil production in the restricted growth scenario. Of course, then it's by definition restricted. Or this is in the OPEC cut. But just in this simulation, actually, it's a bit different from what we saw because there's only OPEC cut to 2021. But then you see that actually shale is the one that is benefiting the most from OPEC cuts. While in the unrestricted, we get this price collapse in 2019, and shale will really go deep down in 2019, but we get a huge price fly up to 2021, and shale will, of course, be the key contributor to see that growth. with, as you see here, up to almost 2 million barrels per day per year in growth. You can also see the same for deep water, and deep water is very much already determined by decisions already taken until 2023. And only if shale is restricted from growth, then we see the biggest upturn from deep water towards the end of the next decade. While if OPEC cut, shale will dominate the market, and then deep water, there will be less room for deep water longer term. As I said, the average decline is 8 million barrels, but this is this curve here. This is the average decline. And it was as low as 6 in 2010, but it was up to 8 in 2013 due to all the new wells coming into the market. So this is the decline, and then we have the growth, which is the distance from this curve up to this curve. And then we have the new supply year on year that is coming in. So this is what you see in 2012 and 13. It was lower new supply than it was demand. So basically it was undersupply and the price fly up. But then in 2014 and 15 we get a huge global oversupply. And then you can see how also the dynamics will be between the red line and the upper green line in these different scenarios, showing you basically another way to show how what is contributing to give oversupply or undersupply. And then this red line could then be broken down in the short and the long cycle, and you see the impact of that. Also, we can use this model to look at the future investments in different in the different segments, whether the investments will be in shale oil, oil sands, or offshore or deep water. For the short cycle and for the long cycle, we have only grouped all the long cycle investments here. And we see that from the peak investments in oil globally, that was just below 500 billion in 2014. This could very well, be the peak investment year ever in the oil industry. In this unrestricted scenario. And we see how this has really collapsed from almost 5 or 460 billion down to below 200 billion. Note this is not including exploration investments, and it's not including gas investments. If you include all of that, you are actually more than 900 billion in 2013. So this is also a feature with the model that you can look at investment scenarios. So I think I will soon round off with just to look at all the this is then decision years going forward. So you see that with all the decisions already taken, we are here today. So this is the decisions taken in 2017. We will produce 68 million barrels in 2025. And then we have to take decisions every year going forward to produce the additional 37. So this is including infill wells and decisions for new field development. But here we have already included all the decisions for new field development, which also includes the wells that is needed to reach plateau level for all of this. So still, this just shows that it will be a very dynamic market, because from now on and until 2025, only 8 years ahead, we have to take decisions to get in 1/3 of the global production by then. So this is, again, just showing you the dynamics of the market and how many decisions we really need to take, and how this is much, much bigger than what is influencing the oil price, which is less than 1 to 2 million barrels per day, is really influencing the market. So this just shows that, again, that of course is very uncertain what the oil price will be, but the patterns is quite set actually. So this is still giving us quite some clue about what is going. So with that, I'm happy to take part in a discussion or whatever after this. Thank you.